So, this topic of decentralization is interesting because it's always um, talked about in the management accounting books, and the way that it's promoted in books is not always the way it is carried out in real life. So I thought it would be interesting to talk about it. But first of all, let me ask you this: have you ever worked somewhere where you're held responsible uh, for something that you have absolutely no control over? And so that's kind of where we start on this journey, is that we talk about cost center, profit center, investment centers, and we call those responsibility centers. Let me do it over here. And so what it's talking about is you should only hold your managers or your employees responsible for things that they have control over. And as you know, and you've probably experienced this, there's been times when you've been held responsible by a superior or upper management uh, for something that you have absolutely no control over. In fact, a person that's over a cost center only has control over some costs. And again, not always, not everything within the cost realm. But let's just say, for example, you're at a factory, or maybe you're at a working in the warehouse, you're a warehouse manager, and goods are coming and going out of the warehouse, and you're responsible for managing the employees and the operation of the warehouse. Well, in the warehouse, you don't set any prices, and you're not really selling anything. You can only manage the costs of maybe the employees, and how there may be some other costs that you have control over, but you have really no control over any revenue, any money coming in. And so a cost center that only has a cost center is a segment whose manager has control over costs, but not over any revenues or investment. Now, a profit center, he can have both control over costs and revenues. So maybe you work in a little retail store and you can set prices, you can run sales, you can do other things like that to promote revenue. And also, you might also have control over certain costs, like maybe your employees and your payroll, that how many people are working on a shift, those kinds of things. Maybe you can even work deals with vendors that supply you to give you sales on specific things. That you have some kind of control over revenue, money coming in, and control of costs on money going out. That's called a profit center. However, a lot of times if you're a profit center, you have no control over the rent of the building, or if the building was for rent or lease, or if the building was purchased and owned by the company, what it costs for electricity, maybe, or advertising for the whole company. And so those are the kind of things that is controlled a lot of times at the corporation, at the headquarters, and we call those investment centers. This person, the investment center, has control over cost, revenues, and investment in operating assets. So this is just really just kind of a quick thing to say, sometimes you're being held responsible for things you don't have any control over. In fact, many times if you work in a union or government or school district or something like that, where the primary costs are payroll and benefits for employees, and you're not able to really add or subtract employees unless it's in the budget from corporate, you really have very little control over costs, even in those circumstances. But that's what this is about when we start talking about responsibility centers. And they introduce this in this section under decentralization. And there's a lot of, all of the books that you get to in management accounting, for the most part, always try to promote the benefits of decentralization. Well, there are benefits, because lower level managers, their decisions are based upon better information because they're dealing with the public. Maybe they're a retail store or a fast food franchise. They're with the actual customers in that specific demographic They know what's going on. If it's a retail situation, they know what sells in their market and what doesn't sell. So they do have good information. And that's a big benefit. So, job satisfaction a lot of time is tied to whether or not you have decision-making authority. So think again about yourself in times when you have some kind of authority to be kind of in control of your own destiny, so to speak. Even if you're working for a big company and you work in a division where you have decision-making authority, you're normally, more satisfied. And lower level managers can respond quickly to customers. I mean, how many times have we dealt with somebody, a company, where, well, they have to go through their boss, who has to go through the regional manager, and the regional from the division, and then, on and on until you get supposedly to the top of the chain. And by then, it could be days, weeks, months down the road. When you typically as a customer, we want responses immediately. So those things are all promoted as benefits in the decentralized organization. And then the whole idea of responsibility is to hold those people at those levels responsible for what they do have control over. Now, I will say this. Just a minute, I'm trying to get another thing. This is disadvantages of decentralization. Now, I will say this. Most of the major chains have moved away. So here's where the textbooks typically promote the idea of decentralization, whereas what we really see in the world, at least among major chains, when I'm talking about chains, I'm talking about like retailers and stuff like Walmart, Target, they tend to be very non-decentralization. They tend to have decision-making made at the corporate level. And they obviously, they believe that there was disadvantages to decentralization, that there could be lack of coordination among autonomous managers. Lower level managers make decisions without seeing the big picture. The lower level managers' objectives are not those of the organization. And difficulty of spreading innovative ideas. But much of the decision making at most major retail chains is made at the corporate level nowadays. And so although the books typically promote the idea of decentralization and giving people autonomy at lower levels, that's not always what we see as organizations get bigger and bigger. Now, because this is an online course and I don't, do hour or 2 hour long lectures like I typically do in the classroom, I don't get to share as many of my great stories. I think they're great, at least I do. I don't know, maybe you wouldn't like them. But anyway, I don't get to share the stories that I like to tell about all these things. So my experience, and I'll tell you one here about decentralization, and then I'll make another video on the next topic. But I was in a food wholesale distribution business. I actually owned a food wholesale distribution business in Southern California. And in those days, the #1 retailer in the United States was Kmart. I mean, they had something like 3,500 or 4,000 locations in the United States. They were the #1 retailer, and they were operated as a decentralized organization. Every store manager had decision-making power at the store level, and it was very successful for Kmart. Each Kmart for different locations throughout the United States could offer products that were specific to that demographic. And if you were in a place like Southern California, where I was, you had Kmarts that were relatively close to one another, but you could have very different demographics based upon the communities that they were located in. And so what might sell over here in East LA may not be something that sells over in Orange County or something, So those managers could work among each other to say, hey, we just got a truckload of surfboards and bikinis, I'll say, because they're in Newport Beach. But you over here in the desert might not be selling those, but you might be selling, something completely different, and we can swap. And I actually saw um, them rent U-Haul trucks and take between the store managers now at store level, uh, load up a U-Haul truck with excess inventory that wasn't selling in a specific demographic and take it over and swap it with the store across town or in a different place that particular um, product would sell. And it was very successful. Well, then what happened to Kmart? And I'm not saying that this is the complete demise of the organization. I'm just saying that this was a component that I actually visually saw. And what happened was Target comes to town, and Target and Walmart was just early on expanding on the West Coast, and they came in and originally, they were hardline stores. They didn't have groceries too much. They'd have maybe a few things, but not really a full grocery section like we see today in any of those stores. And so Target introduced the idea of selling groceries and being more and more of those grocery type items. And Target was known because they were bright inside, they were clean, and Kmart was known as a very compact, full of just piles of stuff everywhere. And again, I'm not saying one of those things is good or bad. I will say that that Kmart did not become the #1 retailer in the United States because they were making so many mistakes back in the days. Uh, and here's where I'm going with this whole story is when Target and Walmart came to town and all of a sudden now they're carrying groceries, then Kmart decides, well, we need to be like Target. We need to be like Walmart. We need to be, and that's when they went through a rebranding. They changed their stores to be called Big K's, and they took out the what used to be a little grill in the back that sold hamburgers and chicken fried steaks. They took that out and replaced it with the Little Caesars pizza place. And they completely redid their branding. They completely redid their stores to try to compete and look like Target and Walmart. And what happened is they not only did they change the look of the store and the feel of the store, but they changed it from a decentralized organization where managers could make decisions at the store level to a non-decentralized or a centralized decision making. So their headquarters was in Michigan. So then it became just like Target, which is in Minneapolis, and Bentonville, Arkansas for Walmart. The decisions were making at corporate headquarters. And personally, I feel, based upon what I saw, that it was a great decline for Kmart because at that point, the store managers were not autonomous. They did not have they could not sell products that were specific to their demographic in their area. And I think it just really hurt the organization. Now, like I said, is this the only reason why that contributed to the demise of Kmart? I don't know, but I could tell you I specifically saw a huge downturn. Now, I teach marketing. I teach all kinds of classes, and go in your MBA program. I'm sure you take those classes, and so you'll see. But what I feel that they did is they alienated their core customer, and the core customer in Kmart was known for a bargain. They wanted the blue light special. They wanted a cheap hamburger and fries in the back while they're shopping that was made by somebody at a grill. It wasn't some kind of brand or franchise like Little Caesars Pizza. Every store had a different feel, except for the fact that they all felt like they were crammed full of stuff, and things were everywhere, and sometimes disarray. And there was a mental thing among customers that when you see a store that's in that situation, that you're getting a better deal. You think you're getting a better deal. And that's what it was all about. Um, and then all of a sudden, you come back one day and the diner's gone. All the stuff in the aisles are gone. The lights are bright and everything's clean and white, and it looks just like a Target. Only instead of red, it's blue. And I think that Kmart alienated their core customer because there were people that shopped at Target and there's people that shopped at Kmart. And when Kmart looked like a Target, um, and they started doing their like I said, non-decentralized, centralized decision making, it devastated the managers' lives because managers were some of the managers had been there for decades and very successful, by the way. Uh, were leaving, retiring, being fired, all kinds of things. So, and anyway, I saw this with my own eyes. I know I'm kind of going on, but this all relates to this idea that you know decentral that decentralization is beneficial, but yet what we really see is a lot of companies going to centralized decision making. So, there's a lot of different things in this chapter. It introduces that. Remember, so it talks about segments. A segment can be anything. It can be a store. If you're on one side of town and you got another store on the other side of town, uh, that could be a segment. You could have a sales territory. You could have a service center. Think about a hospital where you have the operating, the OR, and you have the ER, and then you have the OB, the baby delivery department. Those could be service centers. They're all segments. A segment could be one entire store. It could be a whole series of stores or maybe it could be a department within a store. So this is going to be talking about how do we evaluate different segments. And, I could go on and on about this stuff, but one of the things, I guess I will say this, here's the interesting thing that comes up many times in cost accounting and management accounting. I should just do another whole video on this because this is another topic, but this is traceable, talking about traceable costs, which means it's traced to a specific segment. And in law, they have a term in law that talks about, if not for this happening, this wouldn't have happened. Or if not for you being in this place, you wouldn't have been charged with this crime or something. This is similar to traceable costs. If it's not for the computer division, we would not have a computer division manager. If the computer division goes away, the computer division manager goes away. If the computer division goes away, we still have the company president, we still have the HR department, the purchasing department, etc. These are called common costs, and they are there regardless of a specific segment or not. I can tell you, and I hate to just go into another whole story, but some of these concepts as you're going through them in management accounting, they seem like they're very, common sense, But I will tell you, when you graduate with your MBA, and even now, when you're out and you've gone through some of these classes, you will be in environments where you're discussing things with other people. Sometimes they're your bosses, and they don't see it. They don't get it, especially when you've been through management accounting and you look at everything from the cost perspective. So let me give you an example. The IT department, I know this is interesting, it's about the computer vision. I had a lot of experience with the IT department. They love to come in and say, well, we're going to get this new software, we're going to implement this new thing, and it's going to save us a lot of money. And you may encounter that with a lot of things. Oh, we got to do this. It's going to save us money. It's going to save us money. And you know, they typically will try to sell these ideas to the higher ups who do not look at things the way a cost accountant does, or management accounting, the way a manager accounting would look at it. And what you would look at is saying, well, wait a minute, let's really evaluate whether this is a traceable cost or a common cost. And so what they say is, and this is an exact real life example I had where they said, well, um, we're going to get this software and it's going to replace 3 people. The 3 people are going to go away. And so they each get paid, let's just say $50,000 a year, which they paid more, got paid more than that in the IT department. But let's just say, you know, we're going to save $150,000 a year because these 3 people are going to go away. So it's great to invest in this $100,000 software program because we're going to save $150,000. And so everybody's like, oh yeah, that sounds great. That's wonderful. And then here you come. You're the cost accountant, which of course everybody doesn't always like what you have to say. And you say, well, wait a minute, let me get this straight. So if the organization buys this software for $100,000, you're going to fire these people. Oh, well, no, we're not gonna fire them. We're just going to move them to another section where we're shorthanded anyway, you know, so we're just going to repurpose those people. And so as the cost accountant, you say, well, wait a minute. So the people's salaries are not going away. They're just being shifted. So now we still have the $150,000 cost, but we also have the $100,000 cost of the software. So what that means is the idea that we're going to save money by buying the software, the fact of the people's salaries are completely irrelevant to the decision because we're going to be paying them. Now, if you said, well, I'm going to fire them, you know, we're not going to have those costs anymore, then it's relevant. It's relevant that that you would save the money. So this is a good example of a trace costs. If they just shift them around and we still have the costs, then even though they're not specific to that segment, perhaps to the overall company, they haven't really saved us anything. So I know I've gone to 24 minutes here on this, and I didn't really intend to do that. But anyway, it's great. You can see me anytime you want to Zoom. We have a Zoom, or you want to video chat with me, we can do that. And it's great, and I want you to be successful. I really wanted to talk about some more things in this chapter, but I'll look forward to speaking to you next week.